In a world where people are exploring ways to live without a job, getting money without working, known as passive income, is catching on. One big way is through dividends, a special kind of money you get for having certain investments. But how much do you need to start getting this money regularly? The surprising answer is, it's not as much as you might think. Imagine a plan where money makes you richer, even when you're not working. Last year, a big company called Berkshire Hathaway made over $4 billion from just 5 smart investments. This idea, supported by a successful investor named Warren Buffett, says you can start small and grow your money steadily. Before delving into the specifics, make sure to subscribe to our channel, Financial Freedom, and press the bell icon to stay in touch for future videos. Let's start the video with how dividends work. Your share in company profits. When a business succeeds, it faces many options regarding how to manage its newly acquired revenue. The options are varied. The business can divide the earnings among its stakeholders or reinvest the proceeds into the company's expansion. This profit usually ends up in the pockets of private company owners. The members of cooperative structures receive the profit, and in a sense, they are the group's owners. Within the domain of publicly traded corporations, an intriguing procedure is implemented. The practice of channeling wealth directly to shareholders is commonly seen and is embodied in the phrase dividends. If you decide to buy shares in a company, you are now a stakeholder, a shareholder, to be more exact. Consequently, when the company opts to distribute dividends, you stand entitled to a portion of the profit commensurate with the number of shares you possess. The beauty of dividends lies in their versatility. These payouts may manifest as tangible cash, arriving in your account digitally or as a traditional check. Alternatively, dividends may materialize as additional shares of the company's stock, further solidifying your stake in its success. The frequency of these payouts varies, with quarterly distributions emerging as the prevailing norm in corporate landscapes. Dividend living. Purchasing stock in publicly listed companies ensures a steady return to shareholders and aligns you with their profitability. Investing in well-known corporations like Apple guarantees dividend payments consistently, possibly even quarterly. Consider this harsh reality. Men retire at an average age of 65, which makes one consider the course of one's life. When a person graduates from college at 22 and starts a successful profession 3 years later, their retirement path takes only 40 years to complete. A period that seems long, yet ultimately distills the meaning of a lifetime's work into a small window. Think about how depressing it would be to work 40 years without a break, only to enjoy a short retirement. For many, it's a grim reality. But what if you were to dare to question this established order? What if you changed the course of your financial destiny, taking proactive measures to ensure you have a future free from the traditional limitations of retirement age? Why is this so important? Listen to the words of Warren Buffett on this. Passive income with dividend investments. When it comes to generating income, everyone agrees that there are many ways to idly accumulate cash, renting out real estate and machinery, for instance. But let's face it, everyone, for a minute. Among the many passive income sources, nothing compares to the ease and peace of mind of having money poured into your bank account without any work. Here's where dividend stock investing comes in. Investing in a single stock in the appropriate firm might pave the way for steady profits over time. Think about the appeal of having a lot of money. It would allow you to work less hours or, even better, retire early. It's a stark departure from dedicating hours to a stressful job that consumes your present and chips away at your precious years. Yet as we venture down this lucrative path, precision is paramount. The common pitfall lies in neglecting the future, a mistake often made when investors fail to consider the longevity of their chosen companies. It's not merely about today's returns, it's about building a robust financial future. Opt for companies designed for longevity, boasting a proven track record of sustained and substantial dividends over time. In the words of the Oracle of Omaha, Warren Buffett, a guiding principle emerges. Refrain from succumbing to the errors of the crowd. The gravest mistake, he asserts, lies in hasty decisions influenced by short-term market sentiments. Instead, grasp a profound understanding of your investments. Know what you buy, and most importantly, why. Let's move the intention on how to calculate your investment needs. Calculate your investment needs. Let's talk about a crucial thing called dividend yield first. It's like a percentage that shows how much of a share's price gets paid out as dividends. This number can change from one company to another and even change for the same company over different years. Generally, bigger, more established companies give out larger dividends than smaller, newer ones. Now, here's the important part. You don't need a ton of money to start living off dividends. Some folks miss this because they don't see the bigger picture or the smaller details. To figure out the smallest amount of money you need to live off dividends, you've got to consider two things: how much money you need to live for a year and what dividend yield you can realistically get. Calculating. Dividend yield isn't rocket science. You can use this simple formula: dividend yield annual dividends per share price, per share dividend, yield price, per share annual dividends per share. So, understanding. Dividend yield is about keeping it simple, knowing your costs, and figuring out how much a share pays you back. It's like a key that helps you make wise money decisions. You need to figure out a few things to make your money work for you through dividends. First, know how much money you want each year to live how you like. This depends on what you want and need in your life. Keep in mind that most dividends come in every 3 months, not every month. So, if you want money regularly, it's good to have different stocks that pay at other times. Start by looking at how much money you make now and how much you spend. If what you're making now can cover the life you want in retirement, that's an excellent place to start. But be smart about it. Think about things like prices going up and medical costs going higher as you get older. Once you know how much money you want each year, here's a simple trick. Divide that number by the average dividend percentage. This gives you an idea of how much you need to invest. For example, you want $50,000 yearly, and the average dividend percentage is 5%. You do this, $50,000 by 0.05 or 1 million. But remember, this is just a basic idea. There are taxes you need to consider too. Here's a tip. Dividends can change, sometimes more, sometimes less. So, don't just put your money in and forget about it. Keep an eye on your investments to ensure you always get the most for your money. Working towards your money goal. In the example, we got to $1 million. That might sound like a lot, but it's why it's smart to start saving and investing early. The idea of $1 million alone might be enough for a good retirement, but things like prices going up and the cost of living getting higher might disagree. The cool thing about living off dividends is you don't have to tout your main investment to pay for things. This means you always have a safety net of investments if needed. Also, no one knows precisely how long they'll live. If you can live off dividends, you can meet your needs for a long time, even if life throws surprises your way. Now, let's talk about something exciting. Imagine you get money from investments, like a little reward. If you save that money instead of spending it, something cool happens. For 30 years, you can use the money you get from your investments to pay for your life. But wait, it gets a bit tricky at first. For the first 20 years, you might need more from your investments to cover all your living costs. It's like a puzzle. After those 20 years, though, the money from your investments could be more than you need to live. Here's a surprise. If you invest smartly, you might only need around $300,000 instead of $1.7 million. That's a huge difference. Conclusion. Some believe that you need specific equities that regularly yield large sums of money to survive off of investments. The true secret, though, is keeping your investment income safe rather than consuming it. Just keep in mind that taxes are involved. It's important to know how taxes affect the money you receive from your assets. Therefore, living off the profits from your investments is similar to solving a problem. You may require more money than you anticipate, but as time passes and your savings increase, it will become feasible for you to live off of your investments. If you want more videos like this, subscribe to our Financial Freedom channel and click the bell button. Also, if you found this information helpful, share it with others. Thanks for watching.